studying your last two. I swim with tea when they turned in. The staring down to mute and can lend a pole that sunky died.
The Capital Dividend Account, commonly called the CDA, is one of the most unique features of the Canadian corporate tax system. Unlike paid-up capital or retained earnings, the CDA is not a regular accounting account that appears on the corporation's financial statements. Instead, it is a special tax account maintained only for income tax purposes. You can think of the CDA as a special tracking account that keeps a record of certain tax-free amounts received by the corporation. These amounts may later be distributed to shareholders as capital dividends, which can be received tax-free if all the legal requirements are met. So, what kinds of transactions increase the CDA? One of the most common sources is the non-taxable portion of capital gains. When a corporation realizes a capital gain, only a portion of that gain is taxable. The remaining non-taxable portion is generally added to the Capital Dividend Account. Another common source is life insurance proceeds received by the corporation after the death of an insured person. In many situations, these proceeds also increase the CDA. Certain other tax-free corporate receipts may also contribute to the account. An important point to remember is that the CDA is not a bank account holding cash. It is also not part of the corporation's accounting records or financial statements. It is simply a memorandum account used to track the balance of tax-free amounts that may potentially be distributed to shareholders. This makes the CDA very different from the corporation's other equity accounts. Paid-up capital represents the shareholder's original investment. Retained earnings represent accumulated business profits. The Capital Dividend Account, however, represents certain tax-free amounts recognized under the Income Tax Act. Although all three are related to the corporation's capital structure, they each serve completely different purposes. As the corporation receives eligible tax-free amounts over time, the CDA balance grows. If the corporation later decides to distribute some or all of that balance, it may be able to pay a capital dividend that is received tax-free by its shareholders, provided the required CRA election is made. The key takeaway is that the Capital Dividend Account is a special tax account, not an accounting account. It tracks specific tax-free amounts received by the corporation and creates the opportunity to distribute those amounts to shareholders through tax-free capital dividends. Understanding how the CDA is created is the first step toward understanding one of the most valuable tax planning opportunities available to Canadian private corporations. A capital dividend can only be paid when a corporation has a positive balance in its Capital Dividend Account, or CDA. Unlike a regular dividend, which is paid from retained earnings, a capital dividend is paid from this special tax account and, if all the required conditions are met, it can be received tax-free by the shareholder. The process begins when the corporation receives an amount that increases its CDA balance. Common examples include the non-taxable portion of a capital gain or eligible life insurance proceeds received by the corporation. As these tax-free amounts accumulate, they increase the balance of the Capital Dividend Account. Once the corporation has a positive CDE balance, the board of directors may decide to distribute part or all of that balance to the shareholders. Just like any other dividend, this decision must be formally approved through a board resolution before any payment is made. However, there is one very important step that makes a capital dividend different from a regular dividend. Before or at the time the dividend is paid, the corporation must file an election with the Canada Revenue Agency. This is done using Form T-2054, which is the election in respect of a capital dividend. Filing this election tells the CRA that the corporation intends to treat the payment as a capital dividend rather than as an ordinary taxable dividend. After the election has been made, the corporation pays the capital dividend to the shareholder. Because the payment comes from the capital dividend account and the election has been properly filed, the shareholder generally receives the dividend tax-free. This makes the capital dividend account one of the most valuable tax planning opportunities available to Canadian private corporations. It is also important to remember that the corporation cannot pay more than the available CDA balance. Every capital dividend reduces the CDA balance by the amount paid. Attempting to pay a capital dividend that exceeds the available balance can result in significant tax consequences and penalties, which is why accountants carefully calculate the CDA balance before recommending any payment. The key takeaway is that paying a capital dividend involves more than simply transferring money to shareholders. The corporation must first accumulate eligible tax-free amounts, maintain a positive CD balance, obtain board approval, file the required election with the CRA using Form T-2054, and only then distribute the capital dividend. When each of these steps is followed correctly, shareholders can receive the payment completely tax-free. A capital dividend and a regular dividend may both involve a corporation paying money to its shareholders, but they are fundamentally different in terms of where the money comes from, how it is taxed, and the rules that must be followed before the payment can be made. Let's begin with the capital dividend. A capital dividend is paid from the corporation's capital dividend account, or CDA. This special tax account tracks certain tax-free amounts received by the corporation, such as the non-taxable portion of capital gains and eligible life insurance proceeds. Because the payment comes from the CDA, a capital dividend can generally be received by shareholders completely tax-free. However, paying a capital dividend is subject to several important conditions. The corporation must have a positive CDA balance, and it cannot pay more than the available balance. In addition, before or at the time the dividend is paid, the corporation must file a formal election with the Canada Revenue Agency using Form T-2054. Without this election, the payment cannot be treated as a capital dividend. Now compare that with a regular dividend. A regular dividend is paid from the corporation's retained earnings, which represent accumulated business profits after corporate tax has been paid. Unlike a capital dividend, a regular dividend is generally taxable to the shareholder. Depending on whether it is an eligible or non-eligible dividend, the shareholder may qualify for the dividend tax credit, but the payment is still included in taxable income. Regular dividends also have a much simpler administrative process. The corporation does not need a capital dividend account, and no special election is filed with the CRA before making the payment. As long as the corporation has sufficient retained earnings and the board of directors properly declares the dividend, it can be paid to the shareholders. From an accounting perspective, the two dividends also reduce different accounts. A capital dividend reduces the capital dividend account, while a regular dividend reduces retained earnings. Although both payments involve cash leaving the corporation, they originate from completely different sources within the corporation's capital structure. The easiest way to remember the difference is to ask two simple questions. Where is the money coming from? And is the payment taxable? If the payment comes from the capital dividend account and the required CRA election has been made, it is a capital dividend and is generally received tax-free. If the payment comes from retained earnings, it is a regular dividend and is taxed under Canada's dividend taxation rules. The key takeaway is that not all dividends are the same. A capital dividend is a special tax-free distribution paid from the capital dividend account, while a regular dividend is a taxable distribution of corporate profits paid from retained earnings. Understanding this distinction is essential because the source of the payment determines both the corporation's compliance requirements and the shareholders' tax treatment.